Welcome back, everyone. Today we're going to dive into a slightly geeky, but actually really common and prominent area of tax which might affect you, which is as a business owner, small business owner or large business owner, how should you pay yourself? Through dividends or through salaries? Or are there some other different ways? And specifically, I'm going to hone in a lot on dividends because a bunch of people misunderstand what they are all about. So we're going to cover that for you right now. Before we do, if you haven't already, please hit the subscribe button. Welcome. I am Michael from Offshore Citizen. We're some of the foremost international tax and relocation specialists. So if you are interested in relocating to another country, if you're interested in optimizing your tax for yourself or your business, even if you don't relocate, if you want to have a global structure, you want to figure out how to optimize taxes like Apple and things like that, that particular strategy probably doesn't work for you, but there might be some strategies that are available, then you can please reach out to us. We can offer you personalized advice and specialized custom solutions just for you. You can either book a call with me, calendly.com/Michael-Rosmer, or you can send a message through offshorecitizen.net. All right. So let's just talk a little bit about the fundamentals. I'm a very first principles, break things down to their fundamental pieces kind of guy. And so if you just think you have money in a company, how do you get paid? Now, if you're in something like an S Corp or a sole proprietorship or a partnership, etc., then generally speaking, income just flows through to you, meaning that the income of the company and your income are one and the same. So it's very simple, right? Now, there's a bit of an exception for that in the US, which I kind of didn't really touch on. And this is, okay, well, when you have a separate legal entity, you can either pay yourself a salary, which is a deduction for the business typically, or you can pay yourself a dividend, okay? And so this is the norm if you have a C Corp, you have a limited company, SA, et cetera, all over the world, GmbH. There's lots of different names for the same concept, but fundamentally, there are certain corporate structures which are a separate legal person from you. And what does that mean? That means the company is its own legal entity, and that legal entity pays its own taxes. It can be sued. It's like a separate person. So we call it a legal person, right? You're a natural person, it's a legal person. And so natural persons own legal persons, and legal persons will make money, and then they can pay out to individuals. Now, they can do a few different things here. They could pay a salary, in which case, generally the salary is a deduction for the business. So normally what happens is a business, let's just say it makes $1 million this year, and then it has some various expenses, right? So it'll pay for staff, it'll pay for, advertising, it will pay for computers and cell phones and travel and all these different things. It'll pay for a whole bunch of stuff. And then usually it pays tax on the income after the expenses, right? That's the general idea. Now, there are some exceptions. You can have a system within Brazil, for example, or Belize, or there's one within Romania, and a few other places where there's a taxation based on the revenue. Poland has one like this, and so then it doesn't particularly matter. But generally speaking, you're not taxed on revenue, you're taxed on profit. So if that is the situation, then reducing the profit of the company means less tax, right? And when you pay yourself a salary, just like if you were to pay some other employee, that is an expense for the business, which means the business doesn't pay tax on that income, but you do pay tax on that income, or at least, depending on the country you're in, you will. If you're in UAE, for example, there's no personal tax. If you're in Oman, no personal tax. If you're in Qatar, no personal tax. So then whatever you make from the company is not taxed, and so that's a nice little trade-off. But the point is that that is an expense for the business, right? So it reduces the business's pre-tax income on which it then becomes taxed. Okay, cool. What is another alternative? Well, the other alternative typically is you can pay out a dividend. And so what is a dividend? What is this all about? A dividend, the thing that makes a dividend basically is that it's paid from the the post-tax income of the company, okay? And in theory, there are supposedly some countries where paying out a dividend is a deduction for the company, but that's generally not true. And in fact, within all kinds of different tax treaties and different withholding tax rules and participation exemptions and things like that, what you will frequently see is the comment that if a dividend is an expense for the company, then a bunch of the special tax treatment doesn't apply. And it's very abnormal that that would be the case, okay? So what some people think is they think, oh, this dividend's like, you can only pay these annually, right? No, this is not true. You could, in theory, pay a dividend anytime. Now, what's important about it is not how frequently it's paid. It could, in theory, be paid monthly. There are companies, you can go look, and there's big public companies that pay monthly dividends. There are big public companies that pay quarterly dividends. There are big public companies that pay annual dividends. So you can choose various different dividend schedules, including special dividends. Okay, so there's times when a company will, they're selling off some assets and they decide to award a special dividend to their shareholders. This can totally happen, all right? However, what is important is that what is paid is from the retained post-tax earnings of the company. And so what it can't do is pay out the money as a dividend before taxes, okay? So really important to just understand that distinction. Now, of course, other things can happen, like in many cases, you can borrow money from your company. You got to be really careful with this because in a lot of countries, they will treat that as a deemed distribution. And so that can be an issue. Frequently, you need to pay a fair market interest for that loan. Now, again, it can vary. If you're in Denmark, there's different rules than if you're in UK, which is different than if you're in, I don't know, pick some other country, Bulgaria, right? Different countries have different rules around how they treat loans, but you can borrow money. And so why would you want to do that? Well, generally speaking, corporate taxes are higher than personal taxes. And so usually if you can leave money inside the company, you're gaining a form of deferral. You can kind of compound and grow the money at some rate. Although to be fair, in some countries, for example, Canada has introduced rules where passive income is taxed differently than active income. And so that is a factor to keep in mind. Usually dividends, because they're paid from after-tax income, are taxed at a lower rate than personal income. So just to give you an example, in the US, the highest personal tax bracket federally is 37%, whereas dividends are taxed based on a long-term capital gains rate, and the highest rate there is 20%. There's a couple of surcharges as well, but loosely we'll just say 20%, okay? So it gives you some idea. And why is that? Well, that's because the company's already paid 21% federal tax, and so you're basically only taxing 80% of what's left, and so it's designed to approximately work out as being the same. Isn't always the case. In some cases, you have the opposite. Like, for example, in the case of Singapore, there's what's called the single imputation system. And in a single imputation system, is that if the company has paid tax, then the shareholders do not pay tax. Same thing in Hong Kong. So there's no taxes at all on dividends in Singapore or Hong Kong. So there's different countries do it different ways. Usually, not always, but usually what happens is that for business owners, it is best to try and keep as much money inside the company as possible, not incur personal tax on it, get some deferral, be able to grow the money, et cetera, and then distribute money as dividends. And a big part of the reason why you would want to do that is because when you're getting income personally as earned income, then in most cases, or most countries, that's the type of income that they would apply social contributions to, which are often kind of a ripoff. This being said, not necessarily, you can get something out of there. And whereas dividends, typically you don't have social contributions on. So that's also a really important factor to consider. So usually, for example, if we're in the US and we're looking at S-Corps or single member LLCs, usually what is going to happen is you're going to kind of pay the minimum salary to yourself and then you're going to take the rest in dividend form. Even though technically speaking, it's all flowing to you the same, you treat it differently for IRS purposes. And so again, this varies country by country. I can't generalize all the case because, for example, if you're in Bulgaria and your salary is quite high, you could want to pay yourself a high salary. Why would you want to do that? Because in Bulgaria, what happens is that companies and individuals have the same tax rate. It's a flat 10% tax. So, but then dividends are taxed at 5%. So 10% plus 5% is 14.5% if you take it via dividends. So you're actually worse off than if you were to just receive a salary and pay 10%. Now, the socials on that will be higher than that extra 4.5%. So if you have a low salary, it's better off to have received dividends. But if you have a high salary, because the socials cap at a fairly low level, let's say you're paying yourself $300,000 a year or something, mostly you would just pay the 10% tax on that salary. So it's generally better, not always, but generally better to receive a salary in that specific instance. So you do have to plan this country by country based on what you're doing. And there are sometimes little tricks you can use from one place to another in order to be able to figure out how to optimize what works best for you. So I hope that gives a little bit of an overview of dividends and salaries and the fact that you could borrow money out. Companies generally can't give gifts. That's kind of a general concept within companies. So individuals can, and that can sometimes create some tax planning opportunities. Usually that's not possible with companies. Companies, of course, can spend money on expenses, which some expenses, personal and business, you can end up writing off a bunch of stuff and reducing your cost of living without incurring tax. You kind of get a subsidy on that. This is pretty common in places like Canada, the US, Hong Kong, et cetera, et cetera. But usually there is some limit to that where if you start expensing too many things, those become taxable benefits. So there's this idea of like, what is a personal expense and what is business? And in places like in Scandinavia, Denmark, Netherlands, et cetera, they police this really aggressively. Whereas in other places, they're pretty permissive. For example, Hong Kong allows you to write off all kinds of stuff. So I hope that helps. If you guys have any questions, put them in the comments below. Go and check out some of our other videos, and I'm going to look forward to seeing you on the next video.